This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Do valuations matter anymore? Or is the whole idea of the new style, a new paradigm, fraught with hubris and an echo to the perilous thinking at the peak of the dot-com bubble? We may not know the answer for several years, but at least we can frame the landscape. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. The new style. Well, that was the title of a Beastie Boys rap song that I thought was way cool as a teenager back in the late 80s. It referred to new fashion, new slang, new form of expression in general. And now in my current kind of middle-aged investment planning world, it actually reminds me of stock valuations. The old way of thinking about whether something is expensive or not. We know it's not dead, right? But it hasn't really made you a lot of money the last few years. It actually may have pinned you to the sidelines, or at the very least, had you avoiding the Magnificent Seven and other huge tech winners. So with everyone seemingly saying we're in some kind of AI bubble right now, as I started to do a couple weeks ago, I think we should take a slightly deeper dive and specifically make some comparisons to the dot-com bubble, where a lot of, in my opinion, lazy journalists are very quick to go. So I'll get to that in a minute. But I will say, just to look at the current market environment, here we had another strong month. September was a good month for most U.S. stocks, certainly the S&P 500. Well, it turns out that 5-month win streaks are historically quite bullish for continued strength. In fact, according to Ryan Dietrich, he's a chief market strategist over at BMO, followed him for a long time. According to him, in a year where the S&P was up 5 months in a row, a year later, it was up an incredible 28 out of 30 times. What's that, 90-some% hit rate? This is going back 50 years. So what have I been saying, folks? Success generally begets success, which is the opposite of the way a lot of people think, right? And when they see the market going up, the average investor thinks, oh, it has to go down. It has to revert to the mean. Well, history suggests something different. Doesn't mean that we can't have a pause. Doesn't mean that we can't have a correction. That can happen anytime for any reason. But I would just suggest don't fear positive momentum. And of course, seasonally, we're going into a good period as well. According to Axios, going back to 1950, the final quarter has been positive for stocks 80% of the time, with an average gain of 4.2%. That's double the second highest performing quarter, which is the first quarter of the year. And by the way, when you don't see weakness in August and September, which is one of the weakest periods of the year, that usually is a sign that, hey, maybe things are better than normal. So in other words, just because we didn't get weakness the last couple months did not necessarily mean that there's a negative signal for the fourth quarter. So we are going into the best time of the year for the market. And I think this time around, you can see where the tailwinds could come from, right? Because there are so many people, despite the market's strength, there are so many people who haven't believed it, either for political reasons, right? We've talked about the dangers of conflating your political leanings with your investment positioning. So, half the country, maybe more than half of the country, doesn't like what's going on, right? If you position your portfolio that way, well, you've missed out, right? But I also think there are a lot of hedge fund managers, a lot of institutional managers who got really negative, and maybe rightly so in the spring when the market was getting crushed, that didn't reposition, that didn't get back in. Those folks have to play catch up, or they're going to underperform the S&P by 15%. So we will see. This is not a market prediction call. I have no idea, what the market's going to do over any period of time. But I do think that to bet against the market at this point is a pretty risky bet. And by the way, just a side note, this is also according to Axios. Going back to 1928, they looked at the odds of beating the S&P while sitting in cash. Well, your odds of doing that are about 30% over a 1-year period, 21% over a 5-year period, 15% over 10 years, 0% over 25 years. So again, if you are, there's nothing wrong with having cash, don't get me wrong, but if you are sitting with a big chunk of cash, kind of waiting for a good entry point, statistically, it's very difficult to beat the market that way over the long term and thinking you can time it in that fashion. All right, I'll leave it there. I do just want to say a few things kind of reluctantly, to be honest with you, on the government shutdown. I hate talking about government shutdowns because, by the time by the time the audience and you listeners hear this, for all I know, the shutdown may be over, or there may have been concessions from someone, or an agreement between this person and that person. So I don't want to spend a lot of time on this, but I will tell you history suggests that a shutdown won't derail us. Now, that's not to belittle the pain of certain people who are directly affected. Obviously, we're in the D.C. metropolitan area where a lot of folks are going to be affected, maybe layoffs, furloughs, what have you, so I don't want to be insensitive to that. But in aggregate, at the national level, generally not a lot of impact. I was looking at the betting odds, polymarket betting odds. They think that this will last anywhere from 10 to 29 days. The average, just so you know, the average shutdown, if you go back all the way to 1981, the federal government has shut down 10 times for an average of 9 days. 9 days, according to my research. Okay? So keep that in mind. Generally speaking, and RBC came out with a good report on this, the shutdown itself did not really change the market backdrop. It really, the reaction by the S&P, by the bond market, really had much more to do with what was going on at the time than anything else. So, for example, they noted in the 1990s, there was a shutdown in 1990 through 1991. But, of course, that was in the context of a recession. We were already in a recession going into that, okay? And then they looked at the first shutdown of the post-Great Financial Crisis period. The S&P went down as well, but that was also at a time where there was considerable concern about the U.S. economy and whether we did have escape velocity coming out of the financial crisis. And those are just two examples. I could give you more, but essentially it was the underlying economic backdrop that had a lot more to do with the performance than the shutdown itself, if that makes sense. And I think it'll probably be the same way this time around. Goldman Sachs estimated that GDP gets impacted by 0.15% for every week that the government is shut down. So there's certainly some effect, but the market does not seem to be all that plussed about it. Strategists noted that the S&P has actually increased during the past 5 government shutdowns. And going back to 1976, stocks are generally higher 3 months after the government reopens. So you get the point. I don't want to talk about it anymore. Obviously, anything can happen. Maybe this time, given all the partisanship, this is the time where it's worse than normal. I don't know. But it certainly seems to me that we should not be overly concerned about the shutdown, at least from an investment standpoint. We might be concerned as citizens, but not necessarily from an investment standpoint. So I'll leave it at that. If I come back to you in a week or two and say something different, it's because circumstances went in a different direction. But I really wanted to get to the topic at hand. There's so much talk about AI being a bubble. I mean, you can't pick up a magazine, newspaper, look at a website, look at TikTok, whatever it is, without hearing somebody talk about an AI bubble. And I spoke a couple weeks ago about valuation, but I want to really drill down a little bit more on that because I think it's really important. And by the way, whenever everybody is saying something, I'm not going to say the opposite happens, but sometimes you get a different result than what the consensus expects. So the fact that everyone's saying we're in a bubble, I don't think it's that easy, right? I don't think it's that easy to say that we're in a bubble. Even Jerome Powell, chairman of the Fed, commented about valuations. Quote, by many measures, for example, equity prices are fairly highly valued. So, if you're a student of market history, you probably remember Alan Greenspan's now infamous irrational exuberance speech. Remember that one? That was back on, I think it was December 5th of 1996. All the S&P did after that, according to my math, is double over the next 3 years. Yeah, we know we got the crash in starting in spring of 2000, but still, the S&P doubled from 1996 through spring of 2000. And I think it's really interesting the difference between kind of what people are saying they're doing versus what they're actually doing. There was a Bank of America Global Fund survey that showed a record 58% of respondents think that the global equity market is overvalued. Meanwhile, stock positioning in the same survey is at historical highs. So people are saying the market's pricey, but they're not getting out. They're not selling. I've said this before, I'll say it again, valuation is a very poor timing tool. And just to put kind of a finer point on that, Strategas noted that since 1950, the correlation between the CAPE ratio, which is the cyclically adjusted price-to-earnings ratio that a lot of people follow, the correlation between the CAPE ratio and forward one-year returns for the S&P is a whopping 0.06. So what does that mean? There's no correlation, virtually no correlation at all between valuations and what the market's going to do over the next year. Now, the assumption is that, well, it says a lot more, and I've said this myself, it says a lot more about sort of forward, longer-term returns, like 10-year returns, but even those correlations are coming down. So Strategas also noted that today, the correlation between the CAPE ratio and 10-year returns is currently 0.58. So some correlation, but it used to be 0.7. The historical average over the last 20 years is 0.7. So over time, for whatever reason, the correlation between valuations and future stock market returns has been coming down. So does that mean we're in a new paradigm? I think that would be, a pretty strong, statement to make. But certainly valuations have had a lot less influence on performance than they have historically. Just look. The CAPE ratio, for example, again, the cyclically adjusted price-to-earnings ratio, that triggered a sell signal 10 years ago. 10 years ago. Imagine if you had been on the sidelines and didn't have a dime in the stock market over the past decade. You're probably jumping out a window today, let's be honest. But just to think about the current landscape, there is no doubt that stocks are expensive by just about any metric, right? I mentioned that CAPE ratio. It's crossed over 40 for only the second time in history. The first time was January of 1999. This data is from FactSet, by the way. Top 10 holdings, as we know, we've talked about this a lot, now make up 39% of the S&P. That's a record amount of concentration. Highest price-to-sales ratio ever. 3.3 times price to sale. I could go on. We're definitely, pricey by a lot of measures, okay? And what's kind of unique, I think it's fairly unique about the current environment is how, for lack of a better word, incestuous the concentration and valuation is at the top. In other words, think about this. A couple weeks ago, it was announced that OpenAI is going to invest $300 billion into Oracle's cloud computing. Then a week ago, NVIDIA commits $100 billion of investments into OpenAI. Oracle is then spending billions of dollars on NVIDIA's chips. So NVIDIA invests in OpenAI, who then invests in Oracle, who then invests in NVIDIA. It's, as the guys up at Ritzold Asset Management, recently said, they've reached mutually assured destruction where the tech giants have decided they're all in this together, right? So they're all going to succeed or they're all going to overbuild and overspend at the same time. That's a little bit different. Certainly we saw some of that self-referential, if, for lack of a better phrase, dealing back in the dot-com bubble. Of course, some of those companies were obviously selling to some of the other companies, the Ciscos to the Microsofts and the Microsofts to the Ciscos, but not this close of a connection. And connections that are coming just within a few days of each other, right? Ritzold noted that the dot-com bubble was fueled by investor speculation in immature companies that didn't generate any profits. This time around it's different, right? These tech firms are printing cash flow with insanely high margins. But it's fair to say, I think, that the AI boom is coming from inside the house. It's these companies feeding each other rather than just their stock prices being driven up by individual investors like you saw during the dot-com bubble. But get this, just to give you a sense of what these companies at the top have done. According to Michael Sembalist, he's a blogger I followed for a long time, AI-related stocks have accounted for 75% of S&P 500 returns over the past 3 years, but 80% of the earnings growth and 90% of the capital spending growth. So, in his words, companies are spending like drunken sailors, but they can all afford the booze. Great line. Going to keep using that line. Alan Gula, another blogger that I pay a lot of attention to, he's been spot on for a long time. He came up with kind of 5 reasons why what we're seeing today is not exactly the same as what we saw during the dot-com bubble. So I want to dig into this a little bit because, again, I used the term lazy journalists at the beginning. A lot of people are just saying, oh, AI is a bubble, it reminds me of dot-com bubble, we're going to have the same type of outcome. There's some differences. Certainly some differences in the type of companies involved. I just mentioned that, right? These companies have delivered the earnings and have the balance sheet and have the margins that in a way that the dot-com names, a lot of those did not have, right? That's one thing. But also just in terms of the degree of magnitude of some of the excesses is much different. So just to put a finer point on that, the first point that Gula makes is the dot-com era initial public offering, IPO, gains remain unmatched and certainly were much more significant than what we've seen before. So, I lived through that era. I was managing money during that era. Literally every day there was an IPO coming out that was going up 400, 500, 600% in the first day of trading. Remember Pet.com, some of these companies that weren't even close to profitable, going up hundreds of a percent. And I remember this because, they were allocating these IPOs to us and, a hot IPO, I might get literally at that time, maybe 100 shares to spread out. And so, my best client, I might be able to give 5 shares of one of these deals to. And of course, they would want to sell, the next day. It was a crazy time. That's not where we are today. I mean, in 1999, there were more than 470 U.S. common stock IPOs. 470. The average and median first-day return for those was 71% and 57%, respectively. This year, we've only had 67. 67 versus 470. Average returns 35%, median first-day return 14%. So yeah, the market's been heating up. I don't think there's any question about that. But the IPO fever isn't anywhere close to as intense as it was at the peak of the dot-com bubble. And the dot-com bubble had crazier stock price moves, for sure. I mean, not even close. From 1995 to 2000, the S&P returned more than 260%. But get this, the NASDAQ 100, which is really a concentrated tech index for the most part, NASDAQ 100 was up 1,080% over those 5 years. So no doubt NASDAQ 100's had a good run here as well. But since the lows in 2020, NASDAQ 100 is up about 240%, less than 25% as much. So again, great run for tech, but a quarter of the run that we had leading up to the dot-com bubble collapse, or pop, if you will. What was the third thing that Gula mentioned? Index valuations, when measured properly, are still below record levels. So valuations can get very squirrely because there's a lot of ways to look at valuation, a lot of metrics, and I've always found that I don't like to look at any one valuation metric in isolation because it can send a false signal, and Gula makes the same point. So, for example, price to sales. We're at an all-time, as I mentioned a minute ago, ratio of price to sales in the S&P. And it's a good metric to look at, but it's one of the worst metrics in isolation because it's blind to margins and profitability. It just looks at top-line revenue growth, orders essentially. For a tech company, those are just orders, not how profitable you are in those orders. And as I mentioned, the profit margin growth and overall earnings growth of the tech stocks that I mentioned a few minutes ago, up over 90% over the last 3 years. That was not the case during the dot-com bubble, where revenues and stock prices really became significantly detached from bottom line earnings. So I'm not going to get into all the valuation, nitty gritty, but the bottom line is this market, particularly if you look at the big guys, nowhere near as expensive. I mean, if you look at NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, and Oracle, okay, that basket, they're about 35% of the S&P 500's market cap. Aggregate earnings for those companies, according to Gula, have grown from about $90 billion a decade ago to $560 billion today. Think about that for a second. That's a six-fold increase in a decade for those names. That was certainly not the case during the lead up to the dot-com bubble pop. And by the way, those same companies, those same big tech companies, are expected to earn $670 billion, according to consensus analyst estimates, over the next 4 quarters. So maybe those estimates are too high. We'll see. We'll see if there's some reckoning, next year. But this is real earnings growth. And again, if you look at the aggregate price to earnings ratio for not only those names I just mentioned, but for the S&P as a whole, and you compare them to forward earnings, nowhere near as high as what we saw during the dot-com bubble. And I think you could also say that, if you're just looking at those largest companies in the S&P, they are not more expensive than they were at the peak of the dot-com bubble. I mean, back in 2000, we got to almost 53 median PE for those top 10 names. It's in the 30s right now. Okay, so think about that for a second. We don't have that degree of speculation. And by the way, Tesla is at a triple-digit price-to-earnings ratio. If you back that one out, even looks even more, I don't want to say reasonable, but there's even a bigger gap between today and the dot-com bubble in terms of valuation. Just the last thing I would mention, and again, I don't want to belabor the point, but the last thing I mention is the number of companies trading at more than 100 times earnings, many fewer today than there were. When the NASDAQ 100 reached a pretty much an absurd valuation in 2000, you had something like 170 companies, I believe it was. Yeah, more than that. Yeah, over 170 companies trading with a price-to-earnings ratio, a forward price-to-earnings ratio, by the way, not trailing, based on next year's 12-month earnings, of over 100. Today, they're about 29. So multiple more companies back in 1999, 2000 trading at that astronomical valuation than today. So, the takeaway here is I'm not arguing that these tech names are cheap, but I am saying that we're nowhere near at the levels of excess. And by the way, we're not just talking about stock performance. We're talking about sentiment, too. I mean, investor sentiment in 1999, 2000 was euphoric. You couldn't go on a cab ride to the airport without hearing about the guy or gal, telling you about the latest .com that he bought. We're not seeing that today. I mean, yeah, people talk about AI. Nowhere near the levels of valuation excess, interest excess, positioning excess that we saw back then. The other thing I would just mention is if you look at this year specifically, and this is according to Strategas. So if you look at 2025 and you look at where the return in the S&P has come from, according to them, it's a mix of earnings growth and multiple expansion. It's about half and half. So it's not like it's just been the market getting more expensive that has led to the S&P up over 10%. A lot of it has come from fundamental strength. It's actually come from earnings itself. Now, my guess is going forward, and this is just a guess, my guess is for next year, more of the return is going to have to come from earnings, right? Because, yeah, the market might get incrementally more expensive, if profit margins keep growing, maybe the dollar strengthens a bit. So you could see some multiple expansion potentially, but probably a lot less than what we've seen the last year or two. So for the S&P to have another good year in 2026, earnings are going to have to deliver. And I guess the good news is so far that earnings have delivered, right? I mean, if you look at consensus estimates for next year, they're still over 10%. We'll see if we get there, right? You know as well as I do if we're going to get there, but that's what estimates are calling for. So anyway, I know there's a little bit of a deeper dive than I did a couple weeks ago, but I thought it was helpful to make some of those comparisons because I think you should, when you see these hyperbolic headlines about, oh, we're pricier than the dot-com bubble, priciest ever, take it with a grain of salt. Don't look at those headlines through rose-colored glasses. I don't know if that's the right way to put it, but put your critical antennae up. Let's put it that way. One thing I will say, talked about valuations not being a great timing indicator. I will say that we're almost at record levels, according to FactSet, of household stock ownership. And that could be a signal because, people like Ned Davis, other people that I follow, they have looked at that and they think there's a pretty tight historical correlation between high levels of household stock ownership and lower returns going forward. And that's the simple reason for that is, where's the money coming from? For more stock purchase, right? If everybody's already at an extreme level of stock ownership. So there are certainly reasons to think that maybe returns over the next 5 to 10 years will be lower than the last 5 to 10 years. That's a big reason why I've been talking about consider more fixed income in the portfolio, consider value stocks, consider things beyond, the tech-concentrated S&P. But the timing as to when that underperformance maybe kicks in is very much in doubt. And even if there is underperformance, it doesn't mean that the S&P is going to necessarily do poorly over the next 10 years. It just means that it might underperform not only historical levels, but other asset classes. So again, these are not predictions, just something for you to think about if you're sitting on a portfolio and you're wondering, hey, why don't I have all my portfolio in NVIDIA or the other AI stocks? I think it's important to ferret that out. Just to switch gears really briefly, just a couple comments on the economy. I thought it was interesting that the OECD, which is the Organization for Economic Cooperation and Development, they came out and said basically, the economy doesn't look so bad. And the only reason I mention this is because the market's been going up for the last 5 months. So it's a really good example of if you're waiting around for, somebody to declare recession or somebody to declare that we're not in recession, or you're waiting around for a policy statement, there's a good chance the stock market has sniffed that out and been moving one way or the other months in advance. This is another example of that, okay? But I will say, and I've said this at length, that one of the big catalysts for the market doing better is the odds of recession have been coming down. Back in April, consensus economic forecasts were calling for over a 60% chance of recession. This is according to Apollo. Now those odds are down to less than 30%. The betting odds on Polymarket are down to 6%. What's interesting to me is we've never seen a bigger disconnect between what the U.S. consumer is saying and what the consumer is doing. Chase and I have talked about this a lot, right? That the soft data, confidence data, sentiment data has been very negative, historically almost off the charts negative, in times when you're not in a recession. But the hard data, actual, sales, GDP, job numbers have been more resilient. Well, the University of Michigan Consumer Sentiment Index has moved back down to 55. That's below 99% of data points going back to 1952. Meanwhile, retail sales grew 4.8% over the past year, beat inflation by 1.8%. GDP was revised higher to 3.8%. The Atlanta Fed is predicting that third quarter GDP will be 3.9%. So clearly there's a disconnect there. A lot of it comes down to expectations. A lot of people in this survey think that unemployment and inflation will be higher in 2026. But again, the $64,000 question is, and maybe more than that for many of us, will that derail actual spending? For me, it really, as I've said multiple times over the past few weeks and months, really comes down to employment. If people are getting thrown out of work, that's where this gets a lot more precarious. Right now, you haven't seen that. You've seen some firing, but really it's been more a lack of hiring. You've seen companies sitting on their wallets and purses. more so than outright layoffs. We'll see if that changes over the next few months, but my feeling is and continues to be that if people have jobs, they will continue to spend, regardless of whether they're Republican or Democrat or like the Trump administration or not. And I see that anecdotally with our clients. I'll have somebody come in, tell me how they're very uncomfortable with the market, very uncomfortable with the administration, uncomfortable with what's going on, but they're still taking trips. They're still going out to dinner. They're still putting their kids through college. So let's think about that. I think I'll leave it there. The last thing I'll say on the big picture is it's hard to get bearish, in my opinion, when margins are making fresh cycle highs. So estimated operating margins for the S&P, the highest they've been over the last several years. So what we're essentially seeing is, and maybe it's coming at the expense of new hiring, but companies are more profitable than they've been at any time over the past few years. So it's difficult to envision a scenario of severe deterioration in the labor market, i.e. layoffs, when margins and profits are expanding. Basically what it comes down to. So I'll leave it there. And this is not meant to give you some impression that I'm wildly bullish on the market, that I'm wildly bullish on the economy. I'm not. We're still cautious, but there just isn't a lot of data, if you really drill down to it, that suggests this economy is about to roll over, collapse, more specifically, that corporate earnings are about to collapse. Okay, there isn't a lot of data to support that. All right, let me leave it there. I do have a few thoughts about some individual ideas, so stick with me. I'll be back in a few minutes. Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As always, when I do talk about individual ideas, remember that, in fact, today, the names that I do want to mention, I own personally. We also own in a number of our client portfolios, so you can consider that a conflict of interest. And the way I would put it is, if you are a client, I think you can feel pretty comfortable that we've done our due diligence and we feel these ideas are appropriate for your particular situation. If you're not a client, you really need to do your own homework. I can't manage your portfolio through the airwaves. So with that in mind, the thing that really stood out for me this week, we saw a major move, positive move in healthcare, specifically the pharmaceutical stocks. I mean, like a double-digit move in a lot of the names. Okay, Eli Lilly, ABBV, Merck, those are some of the names that we own for a number of our clients, and I own personally, double-digit positive moves. So what happened? Well, a couple things. Remember what I've said for years, that it's not always news that move stocks. It's news relative to the expectations of the news that moves stocks. So President Trump came out with a plan for sort of an online platform for delivering drugs directly to the consumer. And really, what it looked like is, it allows consumers to purchase discounted medications directly from manufacturers. But, I think the key point is a lot of those drug companies already have direct-to-consumer options, and a lot of the drugs involved were actually drugs that were already discounted. And so I think a lot of people saw that and were fearing the worst-case scenario of outright, drug price caps, drug controls. There was no evidence of that. So that was a better result than what the market was thinking. And then President Trump came out with 100% import tariff, if you will, on pharmaceuticals, on drugs, unless drug companies make a significant commitment to build manufacturing in the United States. And in fact, just at the end of the week, he actually delayed that. So he's going to give companies time, like the Mercks and Pfizers of the world, to negotiate with the Trump administration to say, hey, listen, we're making a financial commitment to bring back manufacturing to the U.S. Again, that was less draconian than what a lot of people have modeled for. And when you do the math, it looks like the overall tariff on pharmaceuticals is probably only going up about 1% in aggregate. So that was a big double dose of better news than what a lot of the worst-case scenarios had been with respect to healthcare. And keep in mind, and I've been saying this for months, you've heard me on this podcast talk about how healthcare was ridiculously unloved. I mean, we were literally at 50-year extremes in terms of relative performance, healthcare relative performance to the S&P. It was about as bad as it has ever been for the healthcare sector. Healthcare sector has also seen the biggest outflow of investor funds in the last year of any sector. In fact, the market capitalization of NVIDIA is almost the same as the entire healthcare sector combined. Think about that for a second. This is from Strategas, by the way. So when you have better news than expectations in a context where the sector is basically priced for failure, that's a recipe for some outperformance. Now, listen, I have no way of knowing if this outperformance is sustainable. May have just been a couple-day pop. But again, double-digit moves this week. And so that's notable. I've argued for the past 6 months, let's keep some balance in the portfolios. Obviously, it's nice to have some exposure to AI because that's what has led this year. But you don't want to become too enamored, in my opinion, with this story du jour because things can turn the other way. And some of these unloved sectors, healthcare, consumer staples, energy, they might have their day. Remains to be seen of whether this is a start of a trend or, again, just a couple-day pop. But regardless, there's still individual names in that space that look interesting. I mentioned ABBV briefly. The analyst at Raymond James has been very positive on their pipeline. Remember, ABBV, 70% of their sales at one point had come from Humira, their rheumatoid arthritis drug, which is off patent, and the sales of that drug have been going down every year for the past 5 years. But at the same time, AbbVie has had a lot of success through acquisition and drug development, bringing other drugs and other franchises online to not only replace, but exceed what Humira was producing for them. And the latest is what's going on in Parkinson's disease. Some of the results that they have released from some early-stage trials over the past year gives the Raymond James analyst a lot of confidence that that could be the next kind of multi-billion-dollar sector for them on top of immunology, on top of what they're doing on the cancer side. So the pipeline for AbbVie, I would argue, is the most promising that it's been in some time. AbbVie also noted this week that they feel really well positioned with respect to tariffs, not only in terms of their existing manufacturing network here in the United States. They can easily route a lot of their production here domestically, but also they believe they've had constructive conversations with the administration about that and about investing more money here in the United States. So, the risk here is there's always individual risk with pharmaceutical companies, right? Drugs can fail in FDA trials. Drugs can have side effects. That's an ever-present risk. The valuation's not as cheap as it was. It used to be a single-digit multiple. Now it's at 15 times earnings, as Raymond James suggests. But relative to their growth rate, they feel they have double-digit earnings visibility over the next 5 years. It's probably a reasonable multiple. And then there's just the macro risk of pharmaceuticals specifically being very policy sensitive. And again, the news this week was more favorable than people thought, but there's always that risk. But if you're a value investor and you're looking for what areas have lagged both in terms of performance and valuation, yet could have promising prospects over the long haul, maybe pharmaceuticals are a place to look. So definitely risk there for you to consider, but I think AbbVie is interesting. I wanted to mention Amazon briefly. I mentioned them a couple weeks ago, maybe it was 3 weeks ago, that people had kind of forgotten about their grocery business, right? Their core, as well as their core delivery business, and how their margins on those businesses were improving dramatically through increased harnessing of AI, new distribution centers, robotics, all those things. People had forgotten about that. People were only thinking about Amazon's sort of AI sensitivity. There's a lot of other things going there. They got an upgrade this week from Wells Fargo because they think their core cloud storage business, Amazon Web Services, is accelerating faster than previously. So if you recall, Amazon's cloud storage product had been lagging what you're seeing from Microsoft and what you had been seeing from Google. And that's largely been the reason why Amazon, until now, has been the worst performing of the Magnificent Seven stocks so far this year. Barely positive, maybe up a couple percent for the year. But they think that that's about to change. They think there's going to be an inflection point here. Wells Fargo noted that Amazon had about 32% market share in cloud storage, and that should increase over the course of the next few years. And they think that given their projected compound annual growth rates, that their overall percentage of the pie will be something like $870 billion by 2029. Okay, that's about 20% compounded annual growth rate. So I don't think that's accounted for in the price of the stock. What's more, Amazon's trading at about 29 times forward earnings. That's a near decade low for an Amazon valuation. Okay? So if you believe that Amazon is seeing better conditions in their core grocery and delivery business, if you believe that their cloud storage business may be increasingly competitive versus Microsoft and Google over the next few years, that discounted valuation, at least in a relative sense, maybe would give you some hope that Amazon could be a better performer going forward. The risks are fairly obvious. Amazon is always going to be a sensitive stock to the economy. If you see a big drawdown in consumer sales, such as you would see in a recession, that's certainly going to impact Amazon. And really just the whole cloud storage market is incredibly competitive. They're up, as I mentioned, they're up against Google, Microsoft. Always going to be execution risk as new technology comes online. But I think it's an interesting name to consider given that underperformance that you've seen this year. Lastly, I'll just mention Costco. I think you all know Costco. Costco, their stock has been down. I think they're close to negative for the year. Maybe it's a flat performance. Costco's kind of taken the year off. I mean, obviously the stock has been a huge performer over the last decade, but it's taken the year off. And a lot of that has to do with valuation. So they're trading roughly 47 times earnings versus a 3-year median of about 38 times earnings. This is according to Raymond James. But if you look at their most recent quarter, they just reported earnings a week ago. I think what was noticeable about Costco, one, of course, is their top-line growth, right? They're modeling 25 to 30 new openings. Their sales per store has been increasing, so there's a pretty direct feed-through from new openings to increased revenues. Most notably for me, their executive memberships, which are their highest margin memberships, most profitable memberships, are now 74% of sales. And those grew almost 10% year over year, with half of the new member signups under the age of 40. This is where they make all their money, is on the membership side, right? So if they're getting traction with younger consumers who are willing to pay more money for the fees, that bodes very well for Costco. As we've talked about before, Costco has some real sort of defensive characteristics in the sense that in an environment where if the consumer does slow down or becomes more price conscious, might go for the deals at Costco rather than some of the traditional, grocery stores or department stores. So Costco, I think, is very well positioned even if the consumer slows down. The negative, as I continue to mention, is, in my mind, is really the valuation. you are paying a lot for future growth. The company's performance, I think, has justified it over the past several years, but there isn't a lot of margin for error. And that's probably the general theme of this podcast that I actually haven't mentioned yet. It's not that, you have to fear necessarily an AI bubble or fear a bubble in certain expensive stocks like Costco. It's more that there just isn't a lot of margin for error there. So if there are any hiccups, if Costco, reports a bad quarter, or if AI spending from Meta or Google, dips in a quarter, there is not a lot of support at these valuations. You could see a 10, 15, 20% correction quickly in those names, just like you did in April when people were worried about sort of a value product coming out of China. Meanwhile, something like healthcare, the news flow has been nowhere near as positive, of course. There have been threats to the top line. There have been threats to the bottom line from Kennedy Jr., from NIH cuts, from, all kinds of things. But there's probably more margin for error because the valuations are so washed out, the positioning is washed out, and the sentiment is washed out. This is why I've been arguing not to go too far in one direction or the other, keep some balance. And just to remind you, the stocks that I mentioned this morning, I own personally. We own them in a number of our client portfolios. Consider that a conflict of interest and consider that in the way that you position your own portfolio. Hope that was helpful. We're going to be getting into third quarter earnings reporting season here over the next couple of weeks, so we'll have more company specifics to share with you. Hopefully this government shutdown does not run too far into my next show. I wish you wise investing as always.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.